Hey, good afternoon, everyone. This is Joe Bacella here at Chaikin Analytics, and I'd like to welcome you to our presentation of looking for consistent cash using income strategies with covered calls. Presenting today is Josh Mindlin, Head of Options Strategies at Chaikin Analytics, along with Tony Zhang, co-founder of OptionsPlay. Throughout this presentation, please submit your questions using the Zoom Q&A window, which is available in the upper left-hand corner of your screen. As a reminder, this webinar is being recorded and a copy will be sent to everyone who has registered. Now, Josh and Tony are here to tell us how you can identify and successfully time great covered call trades by using Chaikin Analytics and OptionsPlay together. To get us started, here's Josh Mindlin.
Hello, thank you, Joe. Welcome, everybody. It's a pleasure to be here with you and Tony, our friend and partner over at OptionsPlay. We're going to take about an hour today. We're going to try and keep it just to that, but we do have a lot of information, so we may run just a little bit more than an hour. Now, today's topic is consistent cash, income strategies with covered calls. So we're going to get into that a little bit later. But first, let's get a little bit of an introduction here. So my name is Josh. I'm the head of option strategies at Chaikin Analytics, and I have been mentored and coached by some pretty impressive people in the industry, floor traders off of the floor in the Chicago Board of Options Exchange, as well as the Chicago Mercantile Exchange, and institutional traders. And I've been blessed to be able to have them as mentors. My job here at Chaikin Analytics is to take what I've learned and be a conduit, just transfer that knowledge to our subscribers here at Chaikin Analytics and help them pair what they're trying to achieve with the tools we have available to them with Chaikin Analytics and OptionsPlay, which you'll hear more about in a little bit. Speaking of OptionsPlay, we have with us, as I mentioned at the top, our friend and partner here, Tony Zhang. Tony, why don't you introduce yourself?
Thanks, Josh. Thanks, everyone, for joining this afternoon. My name is Tony Zhang. I run the product strategy team here, which means that I help design both the user experience and the algorithms that developed that help you find the option strategies here with OptionsPlay. And just a little background, we started this company with the intentions of really changing the user experience of options. What I mean by that is, instead of looking at an option chain where you have a lot of numbers with every single expiration and strike price, what we wanted to do is develop a tool that gives everyone a starting point, regardless of whether you're a beginner or an expert in options trading, to give you a very easy to use interface that allows you to quickly find strategies on any underlying stock, regardless of your directional views on those stocks, whether you're bullish or bearish or looking for income. And today what we're going to do is we're going to show you how you can use this tool in conjunction with the power of Chaikin Analytics to quickly find any income strategy, so you can use them such as covered calls and short puts in order to very quickly develop income strategies for your portfolio. But also what I'll cover today is a little something a little special. We've been doing a lot of back tests on covered call strategies. We've looked at over 2,000 stocks, over 10 years of back test data. We're going to be able to show you some of the data that we've been able to find, some of the interesting things that we've noticed. So we'll share some of that with you today. Thanks, Josh.
Excellent, Tony. I'm looking forward to that. I think everybody else is as well. Just to echo what Tony said, OptionsPlay is a fantastic tool. We're going to show you how it pairs with Chaikin Analytics today. And it really is good for all levels, brand new people and advanced individuals. Tony's absolutely right. He's taken an options chain, which is a complicated thing with lots of numbers, and he's made it easy to kind of go through and hone in, even for very basic people all the way to very advanced people that I coach, and I coach all levels of folks. So let's talk a little bit about the keys to trading options like an expert. You need a few things if you're going to be successful in the options market. And unfortunately, most people are not successful in the options market. Most people don't have the keys, the tools that they need in order to succeed in the options market. So what is that? Well, first, you need an edge. You need a directional edge. You need to understand if a stock is bullish or if a stock is bearish. We do that here by using the Chaikin Power Gauge and Relative Strength. So those are two things which we're going to talk a lot about in a few minutes. The other thing you need is a little bit of a timing edge, because even though you get the direction right, you want to get the timing right as well in order to maximize your profits and to keep you winning. So we have some proprietary indicators that we use, that we have available to our subscribers, so that they can really improve and hone in on their entries and exits. Another big thing that many traders in general miss, but options traders too, is that you need to play good defense. One of the things that Wall Street really does is look at their risk first. Most people I talk to, when I talk to them, they say, man, I could really make X amount on this. And my first question back to them is, okay, but what are you risking? And what are the odds of that happening? So you need to avoid landmines that destroy portfolios. It's really cutting out the big losers. You need to be able to get rid of those big losers. So we're going to show you how you can play good defense. And then we're going to compare those Chaikin analytic features with OptionsPlay to help you find attractive covered call options. As I mentioned before, for new traders, you can quickly and easily find good, great option candidates very quickly and easily. One of the struggles that new options traders have are picking the wrong strikes and the wrong expirations because they don't quite understand how all the mechanics work yet. And so often they pick things that have very low odds of success and poor risk reward. Tony solved that for you. So OptionsPlay helps you with that. And for more advanced options traders, well, you can hone in on exactly the strikes and expirations, balance your risk and reward. There's some wonderful features in the OptionsPlay widget tool that we have on Chaikin Analytics that allows someone like me to go in and say, this is the strategy I'm thinking about. Is the option market going to give me the numbers I'm looking for? Yes or no? And I can quickly and easily, I got to tell you, what used to take a lot of pen to paper and poring over different strikes and trying to calculate break-even, Tony and OptionsPlay have done all that for us. So it's really a beneficial tool, and it pairs amazingly well with Chaikin Analytics. And we've been quoted in the media, which is no surprise. We have a powerful analytics tool. We've won awards with Benzinga. I'll talk a little bit more of that later. You may be familiar with Malden Economics or John Carter's Simpler Trading. We've also have partnered with them. And Mark has been on CNBC quite a number of times. So we're used in the media quite often with good reason. Now, one of the things I want to get into beforehand, and Joe, if you would put up a poll question here. What I want to get into a little bit beforehand is what are the challenges that you are facing as a trader? We've put out a couple of the more common ones I hear. So if you have something other than need a directional edge or time your entries and exits or a lack of confidence, please submit that now. You can type, click on one of those or choose other. And
we're going to give it just a few moments here. I see there's already a good amount of results coming in, but if you don't mind, just take a moment. There's a few listed here: directional edge, timing entries and exits, confidence, or if there's something else on your mind, go ahead and check off other, and then go ahead and chat that into the Q&A window for us if you don't mind.
Absolutely. Yeah, we want to hear that. No, thanks, Joe. Yeah, we want to hear that. We want to hear what your challenges are. One of my jobs is to help people overcome their challenges. And these are common challenges. You're not alone in these. These were challenges I had when I started, and they're also fixable. That's the beauty of these. All these challenges are fixable. So whether you're struggling with the directional edge, which is absolutely critical, Chaikin Analytics can help you with that. They help me with that. If you're struggling with timing, entries and exits, these are also things that people tend to struggle with. I mean, just think to yourself, have you ever been in a stock and you've been watching it go up and go up and go up, and you're thinking to yourself, oh, man, this is a great profit. Maybe I should get out now. And then you think, no, I'll just hold on for a little while longer. And then it goes against you. How many times has that happened? I find that oftentimes people in the stock markets, adults in the stock market, are like kids at the pool. They never want to get out once they're in. So you got to learn to have exits. We can help you work and find the answer to that. The other thing that tends to happen is people buy and then it immediately goes against them and they panic. And that comes from a place of confidence. They don't have the confidence that the methodology they're using is really going to work. That's why that people tend to do that. They tend to buy high, panic, and sell low. if you had the confidence to know that you had an edge, you might not get shaken out by some of these little fluctuations in the market. And it'll keep you in trades that have good odds. So let's see what we got here. Yeah, entries and exits. It doesn't shock me that that's overwhelmingly. Joe can speak to this too. We work with people all the time. Joe and I are on the same team here. Well, everybody at clients, everybody in Chaikin Analytics is on the same team, but we work in the client success department, and we hear this all the time. Joe coaches people, I coach people, our other colleagues in client success coach people on how to get better entries and exits using the indicators in Chaikin Analytics. So let's get into that. One of the things is that people also struggle with is information overload. And this is a big one. I used to coach a guy, he's an engineer, his name's Jeff, and he tried to take every piece of data point that he could find and use it to make a decision. And it's just, you just can't. You can't try and do that. That's not, what you need to do is be able to cut through all the clutter and hone in only on the data points that matter to your profitability. You know, you can turn on CNBC 1 minute, there's a talking head that says buy Amazon. The next segment, 20 minutes later, there's a talking head that says Amazon's overpriced, you should short it. You can get so much conflicting information out there. One of the biggest challenges people face, and I think this lends to the lack of confidence, is they just have too much information, and they need to be able to cut through all that. So Mark Chaikin has solved that. The solution is Chaikin Analytics. Chaikin Analytics can help give you the critical directional edge you need to be among the 5-10% of options traders that are consistently profitable. It can help you with your entries and exits. And I'll tell you, when you start following a disciplined methodology and making money, you get a lot of confidence in what you're doing. So let's go into this in a little bit more detail. How do we get this directional edge? Well, we have what's called the Chaikin Power Gauge. It is a quantitative model that takes into account both fundamentals and technicals. When we combine this with our relative strength indicator, which we'll talk about a little bit later, you have a very powerful directional edge. Add on the proprietary indicators, now you have better option entries. Being able to get better option entries are enormous. Options are leverage, so every little bit of better entry you can get can add many percentiles onto your potential profits. This is from Jim. Jim's somebody that Joe and I have coached, and Jim said, hey, I do what the system tells me, and I enjoy my 16%. Now, Jim is doing a very conservative approach, and achieving, good annual returns. He has an approach that we're going to talk a lot about tonight, which is covered calls. So that's what Jim's doing. We have other subscribers that are taking more aggressive strategies. John Carter is someone who has well followed, many followers, and he has more aggressive strategies, and he calls what Mark Chaikin developed an awesome meter for stocks. And I don't think I can come up with a better phrase for it. It is an objective awesome meter. Objective awesome meter. The power gauge rating is a quantitative model. It has no emotions. It doesn't get fearful. It doesn't get greedy. It's objective, and it is an awesome meter. So what is it? Well, as I said, it's a quantitative model. Takes into account 20 individual factors grouped into 5 areas. You can see there's financials, earnings, technicals, and experts. Now, the model is 85% fundamental. And you're saying, well, Josh, it looks like a quarter of it's technicals. Well, these are weighted differently. Mark went and he figured out what of these factors need to be weighted in which ways to help give you a consistent edge in directionality going forward. So we've taken these 20 and they give you a composite ranking: bullish, bearish, very bearish, or neutral. And we have some results. We tracked this stuff. So here's our 2016 results. 2016 was a pretty good year in the market. The overall market was up 24%, a little smidge above 24%. You can see our neutral stocks performed at 24.9%, right about at the market. That's what they're supposed to do. They're supposed to be market performers. Now let's look to the right. You'll see our very bullish stocks. In an incredible up year from the market, the very bullish stocks outperformed those stocks by over 25%, an extra 7% for you. Even the bullish ones did 4 or 5% higher. And now look at the very bearish ones. Can you imagine sitting down with your buddy and he says, yeah, I don't do any of that individual stock selection. I just picked the SPY and I got 24% this year. And you look at yours and you have all these very bearish stocks and you've only done 11%. That's not good. You want to be able to look at your buddy and say, oh, I got 31.8% this year because I had the right tools. Now, that was a good year. What about a bad year? Well, 2015 wasn't such a great year for the market. The market was down in 2015 by 7.65%. How did the power gauge rating work? Well, the neutral stocks, again, came right at market performance. That's what they're designed to do. Model's working. And if you look at the bullish stocks, well, they were down 1.25%. But if you're down 1.25% and your index friend buddy is down 7.5% or more, you're doing pretty darn good. But think if you had all those very bullish stocks in there that year, not only are you not up, but you're like way down. And those are the things you need to avoid. When a stock drops by 20, 30%, the percentage gain you need to make that up, it gets bigger and bigger and harder to overcome. That's how portfolios get killed, big losers. So if you could just stay away from the very bullish stocks, I'm going to tell you that's probably worth a lot of money to many portfolios out there. Now instead of picking out individual years, let's look at the whole performance overall. And you can see the real world performance tracked back to 2011. On average, stock market up 9.7, neutrals just about at the market. And you can see, once again, very bearish, very underperforming, very bullish, much overperforming. And in this way, because I have this tool, I have the ability to pick stocks that are likely to outperform over and over and over again. And more importantly, I understand when they're going to change and stop outperforming. I know when to get out. And we're going to show you how to do that today. Now, the power gauge rating is titans of industry in the financial industry partner with us with this power gauge rating. We have indices with NASDAQ. So we have Chaikin NASDAQ indices. We also have a relationship with New York Life's Mainstay Investments. Now, this is just proof of the real world value of the power gauge rating. New York Life Mainstay Investments is building ETFs based off of the power gauge rating. It's very impressive. It's proof of concept if there ever was one. And that's the best testimonial I could share, is the fact that they're using it to create financial products. But we also get ones like this from Harry. Now, he was doing more aggressive strategies, not necessarily covered calls. He was doing more aggressive strategies, but we were able to help him take his options trades from meh to really, really good to very happy. So he sent this in to thank us. So today, you'll discover how to set up high probability options trades, how to use OptionsPlay, how it can show you how to understand risk reward in plain English, and how to find ideas for options candidates. Because once you understand what a good options candidate is, have the directional edge you want, and have the timing you want, you just want to be able to find more of them. So we have many ways for you to be able to do that here at Chaikin Analytics. Tony, why don't you talk a little bit more about the OptionsPlay integration and the features on it?
Yeah, thanks, Josh. So the screen that you see today, or on your screen right now, is the OptionsPlay widget. This is what you get for clicking on the options button within Chaikin Analytics for any stock that you create, any stock that you're looking at. And what it does is it presents you 3 strategies, regardless of what your views are. It'll always present you 3 strategies to take advantage of either a bullish or bearish view on any underlying stock or ETF. And what we provide you is the 3 strategies and different panels to give you an idea as far as how you can fine tune each strategy so that you can quickly decide which strategy is best suited for you. And the 3 strategies that we always default to are the 3 most popular strategies for investors. So if you're bullish, we're going to present to you buying the stock, buying a call, which is a simple option strategy, and buying a call spread, which is a more advanced option strategy. So depending on whether you're a beginner or an expert, you'll choose one of the 3 different strategies, and it allows you to put the 3 side by side and compare them. And that's really part of the power of OptionsPlay, because not only are we here to help you quickly find strategies, but we're also here to help you, improve as a trader. So if you've never traded an option before, you can make a simple comparison of buying a stock to buying a call. And if you're a bit more advanced, you can take a look at going from single leg option strategies to multi-leg option strategies, which provide you additional benefits. And we have different panels to give you the tools that you need in order to decide which one's best suited for you, such as a P&L simulator, so you can create any what if scenario and see which strategy gives you the highest return. And that's really the power of OptionsPlay, is to give this to you essentially simply by clicking on the options play tab, giving you this information instantly without having to go out there and search for a option strategy that suits your directional view on the underlying stock.
It's a very great tool, Tony. I use it for educational purposes as well. One of the benefits of it is because you can compare things side by side. For new options traders that we're coaching here, we can show people exactly how your risk and reward change when you go in the money a little bit, out of the money a little bit, change your durations, add the vertical, the spread, so adding a multiple leg to it. I'm able to quickly and easily, couple clicks, explain very complicated concepts with clear, easy, understandable terms and numbers in front of you. And I don't have to go through, an options chain, with 50 different strikes for 8 different expirations. So thank you, Tony. I use the OptionsPlay all the time in my weekly educational series that we do here.
Great. I'm glad to hear that. That's exactly what we built this for.
It's educational in nature, so we appreciate it. All right, we'll get back to OptionsPlay in a second. I want to talk a little bit about how we identify good options candidates and how we identify good trading candidates in general. So what we look for are what we call classic bulls. So what is a classic bull? Well, a classic bull has 3 main features. First, power gauge rating is bullish. That's our quantitative model, the power gauge rating. It gives us a forward-looking view as to what is likely to occur. The next thing we look at is relative performance. What is relative performance? Well, what we do is we have a proprietary relative performance indicator where we compare a stock to the SPY, which is the ETF that tracks the S&P 500. And I'll tell you, sometimes I think people overcomplicate things when it comes to the market, right? So if I told you I had a below average sandwich for you, would you want to eat that? I want to sell you a below average car. Interested in buying that? No, of course not. I mean, it sounds like a silly question. Who would want such a thing, right? So why would you want a below average stock? You wouldn't. So what we've done is we made it easy for you to identify what is a below average stock. Lastly is Chaikin Money Flow. Now this is an indicator that Mark built for institutions and for people competing with institutions, other professionals competing with institutions. It's now widely available. It's on any brokerage platform out there. I mean, it's ubiquitous and it's important. It tells us what is likely going on with institutional buying and selling, because who moves the market? I'll tell you, it's not me. When I put in my order to buy shares, Pretty sure I'm not moving the market. If any of you out there, when you put in your orders, think you're moving the market, please contact me. I'm available for adoption. It's just individuals like us, we don't move the market. Who moves the market? The institutions. So it's very important to understand which way the institutions are positioning themselves. You want to play the direction that institutions are playing. And so these indicators help you do that and help you stay in nice, strong stocks. So the first example I picked out here was a company called Blue Cora, which, to be perfectly honest, I was not very familiar with before I started working at Chaikin Analytics. And I ran a screen for classic bulls. We'll show you how we do that in a little bit. And it popped up. I said, well, this is interesting. So not only am I getting an idea that I normally wouldn't have found in front of me, I'm getting an idea that has a very good edge in directionality. And it's telling me it's going up. At the very bottom of the screen, you'll see right down here a little ribbon. It's mostly green. It's got a little yellow in it. That's the power gauge rating. Now, the power gauge rating gets updated every night. So we crunch a lot of numbers here. It gets updated every night. And what we do is we combine that power gauge rating with the relative strength to tell us, are we bullish or bearish? And so just between these two right here, I'm pretty sure I'm going to be bullish. That's as quick and easy as it is. With Chaikin Analytics, I can look at almost any stock and in a couple of seconds decide whether or not it is likely to go higher or lower. Now, I don't know how many of you can look at your stocks and have the same confidence I do that I think something is going higher and lower and do that in just 3 or 2 seconds. But that's what you get with Chaikin Analytics. It's almost as easy as red light, green light. If you're good with traffic lights, this is going to work nice and simple, right? Because it's green and green, we're going up. And I'll show you what red and red looks like in a little bit. Now, right above that, we have one of our proprietary indicators. It's an overbought, oversold indicator. We'll talk more about that later. We use this for timing. Above that, we have money flow. Look at how green this is. You see there's a little bit of red in there. Don't worry about that. We'll teach you exactly how to use money flow. But a little bit of red is a little bit of profit taking. Institutions need to book their profits just like you and I do. So, but generally speaking, look at all the green in here. This is institutions accumulating. They're accumulating the stock in these areas. Right? So it gives me nice confidence that this is going to continue higher. Well, I'm bullish on it. I feel it's going to continue higher. Now I just need to time my entries and exits. As I said, I use that overbought, oversold indicator right below the money flow. And the other thing that we use then are these bands. So there are a couple lines going across the chart. Let's talk about those for a minute. Let's start actually with the gold line. It's this gold line right here. That is a long-term trend line. 200 period double exponential moving average. You don't need to know what all that means. Honestly, all you need to know it's a long-term trend line. Right? After that gold line, we have these 3 white dotted lines going across the screen. All right, so we have an upper band, a lower band, and right along the middle here is a middle line. Now that middle line is a 21-day exponential moving average. You can replicate it on any platform, any charting platform. You can replicate that middle line. The outside dotted lines are proprietary Mark Chaikin volatility bands, and they are great. They help me understand what the likely range is for a stock. And if I know the likely range, I have a really good edge in when is going to short-term high and when is a short-term low. So all I have to do is line up my oversold moments when we're toward the bottom end of the range and take my positions. If I want to hold them long-term, great. All I have to do is look at the power gauge and relative strength. They're both green. I'm good to keep holding. Think about the simplicity of the statement I just said. If I'm a long-term investor and I want to understand whether or not I should continue to hold my investment, all I have to do is give a check to this, a check to this, and that's it. That's it. Off I go. I can flip through my entire portfolio. It takes me minutes just to understand. And for short-term trading, it's not much more to it, honestly. And people often say it's got to be more complicated than that. No, stop overcomplicating trading. We have exactly the tools you need. And I use them actively. I love them. Let's take a look at another example real quick. This is WellCare Health. Again, you see the same thing. Stock all year, bottom left to upper right. Beautiful chart. Down at the bottom, what do we have for the majority of the year? Wish that would stop popping up every time I try to highlight the bottom, but all right. There's a relative strength in the power gauge, and they are green for the majority of the year, except for a little bit of yellow that crept in over here. But trend line really never stopped pointing up. So we're good to go. Good to go. Takes me just a second to understand that, look at it, and then I can move on. Now, one of the things I put on this image here, you'll see are these green arrows. We have in Chaikin Analytics a number of buy-sell signals. I toggled on, we have 6 pairs of buy and sell signals that are available for different types of traders or investors. I happen to toggle on the oversold buy, overbought sell, and then you can see each time the signals come up. And those are pretty good entry points. The signals have a pretty good hit rate also, and so they make it nice and easy for you to understand when's a good time to get in. Have you ever looked at a stock and thought, man, I think this is a good time, and then not taking the trade and then watched it take off? That's confidence in your strategy. If you had confidence in your strategy, you would push the button. I know you would. I coach people all the time on this. And this is something that you can have. You can develop this. With Chaikin Analytics, I have it. I talk to people all the time because I will put out trades in various places that I've taken through various mediums that we have. And people will say, Josh, this is going against you. What are you doing with it? And I'll say, I looked at the power gauge and the relative strength, so I'm sticking with it because I have confidence that it's going to work out in my favor. And most of the time it does. I have a directional edge with Chaikin Analytics. Now, those are the good ones. Let's talk a little bit about avoiding the losers, right? How to play good defense. So Herb Greenberg, a famous investor on Wall Street, once said, it's the stocks you don't own that matter. And that's very true. You need to be able to avoid terrible stocks that kill portfolios. So you want to know what stocks not to buy. You can improve your performance greatly simply by eliminating the losers. Sort of cut out the weakest link. Then you're left with winners. And this is what good portfolio managers do. They clip their losers and their winners run. So what does a losing stock look like? Well, we call those classic bears. Classic bears are the inverse of classic bulls. Again, we're looking at first and foremost the power gauge rating. We want it to be bearish. That tells us that going forward, our forward-looking indicator is saying this is likely to continue lower. Now, next, relative performance weak. This is a place where we want that under average stock, below average stock. All right. So if we're going to short things, that's what we're looking for. If we're going to be long stocks, that's what we want to avoid. And then finally, we want to look at money flow to let us know what are the institutions doing. They're the ones that likely are going to affect the stock in the near term. Which way is it likely to go? So I picked out Under Armour. And you'll see, even in Under Armour, we have this bearish, poor relative strength, bearish power gauge rating for pretty much the entire year, and Under Armour for pretty much the entire year, downhill sliding. Now, this screenshot for this slide looks like it was taken back in early July, and you can see a little bit of bottom fishing came in here. Some institutions look like they decided maybe you were short covering. Could have also been short covering, but there's a little bit of institutional buying going on here. Now, without the power gauge and the relative strength, that might scare people out. But if you just look south, you'll see, hey, they're both red. They're both red. Odds are going lower. So that was the end of July. I took this yesterday. That was here. Previous slide, we were sitting right here. And look what happened. Down from 20 to 16. That's a 20% move from that spot there. And I knew which way was likely to occur simply by looking down at the power gauge and the relative strength. They're both red. Odds are we're going lower. Again, I put on a couple of our proprietary buy-sell signals here. You have a couple of sell signals here. You see, if you would have gotten in on these, would have paid for a couple of Chaikin Analytics subscriptions. And you can see institutions were selling. This sideways movement here that we see in November, December, January, the sideways movement, slightly lower, slightly sideways, was being accompanied by enormous institutional selling. Likely move, down. So there's another one, TripAdvisor. So I have so many of these examples. I couldn't possibly go through all of them. But you'll see, again, overbought, oversell, sell signals here. A couple nice trades. Another one just recently came up. TripAdvisor in early July. So this is from July. And again, you can see market agrees with the model. Power gauge is bullish. Is bearish. Relative strength, bearish. And the stock, down. Happens over and over and over and over again. The directional edge that I gain with Chaikin Analytics is not just powerful, but valuable. And it's quick and easy. It's a fast and efficient process. So instead of getting bogged down in due diligence, you can take confident trades. That's what Mark did. It's, again, we can tell you if you have a rotten apple in your basket of stocks. I could tell you in a couple of seconds just by looking at the power gauge and the relative strength. We call those the dynamic duo because they really do help us understand which way something is likely to go, which way is an equity likely to go. They also can help us understand when it's likely to stop going that direction and change directions. So here I pulled a chart of Anthem right off of our platform. And you'll see for the beginning part of the year, all the way to the left, Anthem was slight downtrend, right? And we had what I would call a slight bearish indication, right? So we had underperforming and neutral, which is not bullish by any means. That's what I would call mildly bearish, and we slunk. And then what happened? Well, in November, we saw what we call a personality change, a bullish personality change. First thing that happened was the power gauge turned bullish. You got nice solid green going now. Next thing that happened, relative strength flipped. And when both of those turned green, what direction did the stock go? Up. And you'll see there was even a relative strength buy sell signal that came up in January. Would have been an excellent entry point for a long-term position. And money flow, very green. A lot of institutional activity in this stock. A lot of institutional buying. So that's what it looks like when it's going south and then turns around and starts heading north. What most people I talk to worry about more, though, is the other scenario, when it's going up, and then starts to roll over. So we can do this for both ETFs. So here's one of the XLE. This is the energy sector, the ETF that tracks the energy sector. And you can see we don't have a power gauge rating for the ETFs yet. We have what we call the power bar. I didn't put the power bar up here, but it's the number of bullish to bearish stocks inside. And we use that and the relative strength to give us a sense of where's the likely directionality change going to happen. And here you can see that when the relative strength changed, we crossed through that long-term trend line and it was south from there. Now that's on the ETF, so we can help you with ETFs as well as stocks. What I did then was I went into the energy sector and I looked for an example, which should have been easy to find, and it was. There were tons of them. right? Because if the ETF is turning around here, then a lot of the stocks are either leading it or lagging it or going to be close to it. So I looked at Anadarko Petroleum, an energy company, and you saw a bearish personality change. What happened? Well, in the bottom left, you'll see first thing that happened is we went from green to yellow. It's not a great sign, but it's not a panic button either. Then we hit red. There's kind of the panic button. And shortly thereafter, maybe a few days later, we crossed over. We had this personality change occur in the power gauge and relative strength. And if we look up past that personality change, you'll see we crashed through the long-term trend line and we started heading south. And that was the time. If you were long Anadarko, that was the clear signal. The 3-second glance at this and go, ooh, got to get rid of this. Take the next sign of strength. I got to get out, or just cut your losses, or take your profits, or whatever it is. But that's the high probability signal that says we've gone from bullish to bearish, and south is likely where we're headed. A little bit more about money flow. As I said, money flow can be a really good indicator to help you understand what's going on with a stock. What's happening under the surface. So I want to pick out an example here, and this is from Advanced Auto Parts. Advanced Auto Parts also had a bearish personality change here in February. It wasn't exactly doing all that well beforehand, but you'll see right here, we have a flip to negative, and we start getting bearish again on the power gauge rating. And what happens right above it? Well, we cross through the long-term trend line and we start heading south. But one thing I want to point out is the yellow line on the chart there. It's pointing to an area where the stock is really going sideways, but poor money flow on a stock that's going sideways. That is distribution happening. That tells me that that basing occurring is a distribution. It's not an accumulation. Institutions are selling into that strength. And money flow picked that up ahead of the power gauge and the relative strength. Sometimes it can give you a little bit of an early warning that something's coming in down the pike. And then you just wait for the confirmation. And as soon as you get that confirmation, time to exit or start looking for shorts. If you're an options trader that likes doing bear put spreads or just buying the singles, bear puts, that's the clear signal that it's time to take bearish opportunities here in this stock. So that was Advanced Auto Parts. Right? And we see this dynamic happening over and over again. We see when these stocks roll over, commonly these things happen, the same signals occur over and over and over again. You see the rollover of relative strength, you see the power gauge go down, and that's it. It's time to get out of that stock. So we've just gone over quite a bit. The power gauge and the relative strength, first and foremost, they give me my directional edge. Then we have the overbought and oversold indicator, along with these bands that help me get the timing. Once we have all that information, then it's about pairing it with the right strategy. So what we want to really focus on, the strategy we want to focus on tonight, is a conservative strategy called covered calls, which is basically writing calls. So I want to ask if Tony would come and assist me with this a little bit and help explain this to everybody today, a little bit about the covered call strategy and its benefits.
Yeah, thanks, Josh. So now that you guys have seen the power of the Chaikin power gauge in helping you identify bullish and bear stocks, we're going to talk about how you can take those stocks that are in your portfolio, either existing stocks that you have in your portfolio or stocks that you buy because of a bullish Chaikin power gauge, what you can do in conjunction with that to generate some additional income for your portfolio. And one of the easiest ways to do that is using cover calls. This is a strategy that doesn't add any additional risk to your portfolio. And by selling out of the money calls against stock that you currently own, you can increase the yield of that stock by introducing an income stream by selling cover calls. So just a little background for those of you that are new, a cover call is selling one single call contract against 100 shares of stock that you own in your account. And the expiration and strike price that you choose for that call is extremely important in determining how much yield that you're actually going to get from that covered call. So the strike price that you sell it at is going to be the one that causes is the price that you'll sell your stock at. Josh, can you move back one slide? Thank you. So when we talk about choosing an expiration date, this is where I'm going to talk a little bit about all the back testing that we've done. When you're doing a cover call, there's two things that you need to select. Number one, you need to select an expiration date and then a strike price. So when we talk about expiration dates, and this is something that you'll be able to see when you're on the OptionsPlay widget, when you click on the income tab, is you can choose different settings: short-term, medium-term, long-term. Short-term referring to active traders that, if you have lots of time to look at your portfolio every day, you might want to choose something more on the shorter end of the spectrum. If you're a long-term investor that looks at your portfolio once a month, once a quarter, you definitely want to choose somewhere on the longer end of the spectrum. And then for those of you that are in between, you want to choose somewhere in the middle. So 21 to 49 days out in terms of expiration dates is usually what most short-term cover call traders look at. Longer-term ones usually look at anywhere from 3 to 6 months out. And then for those of you that are in the medium term, anywhere from 1 to 2 months out is generally the range of expiration dates that you want to choose. So the thing about choosing expiration dates is that the shorter end of the spectrum, it requires less, is going to give you less premium, so less yield. The further you go out, the more premium you're going to find in your cover calls. However, there is a trade-off. So the less premium you have, the more certainty you have. And what I mean by that is, when you're selling short-term cover calls, generally speaking, when you have a short window, you have a pretty good visibility as to what's going to happen the next 1 to 2 months. Meaning, if there's earnings coming out, if there's a dividend coming out, if there's a news announcement or a product launch, it's usually easier to figure that what's going to happen the next month or two than over the next 3 to 6 months. So when you're trading off less premium, you do get more certainty. And if you try to get more premium, you get less certainty. So the question becomes, what's best? And we've been running back tests for over 10 years now, going from 2007 to 2016. So including the full business cycle, including the financial crisis. And we've been doing it on the top S&P 500 stocks. We've tried all different expiration dates, all different types of entry points. And what we found is the best thing to actually choose is to choose expiration dates that are on the shorter end of the spectrum. So somewhere about 30 to 45 days out gives you the highest returns. And the reason for that is actually very simple. When you're selling short-term calls, so for example, if you sell a 30-day call, you can do that effectively approximately 12 times a year. Versus if you do a long-term call, let's say you do a 90-day call, then you could only do those 4 times a year. And the problem with doing long-term calls is that if you do 4 30-day calls throughout the year, almost every single one of those calls will have an earning cycle built into it. And earning cycle is what causes a lot of uncertainty. It usually causes gaps up or down, and there's really no good way of predicting earnings per se. So that's why, generally speaking, you want to choose shorter dated options, because if you do 12 one-month calls, only 4 of those of the 12 options will have earnings included. So only 25% of the cover calls you sell will have uncertainty. Versus if you do long-term calls, almost 100% of the calls you sell will have a large uncertainty factor built in. So it's always best to have certainty in terms of what's going to happen and choose less premium over that than to take more premium up front and have a lot less certainty in what you do. So based on our back backtesting, it's usually best to be on the shorter end of the spectrum. So choosing expiration dates anywhere from 30 to 45 days out. And that's one of the settings that you can actually create on OptionsPlay. So when you go to your income settings, you can choose to have short, medium, or long term. Based on our backtest, short term is best. Now we're going to talk about strike prices. Josh, can you just forward one? Yeah, thanks. So when we talk about strike prices, this is where you determine what strike price do you want to potentially sell your stock at. So if you buy a stock at 100 and you sell a call at 105, you're effectively saying that I'm okay with selling my stock at $105 on expiration date. So the question becomes, how do you choose your strike price? And when you're on the OptionsPlay tool, you'll see 3 different settings. You can choose conservative, optimal, or aggressive. What this means is, for conservative traders, this is really for those of you that have stock that you've held onto for a long time. Perhaps you have a very low cost basis on the stock and you don't want to lose the stock, or perhaps it's stock that you have that you rely on the dividend for, and you want to make sure that you keep that stock. So for those of you that are in that camp, you want to choose the conservative end of the spectrum. On the other end of the spectrum, for those of you that are really looking to maximize yield and you're okay with losing your stock, you want to choose more on the aggressive end of the spectrum. And then most of you will fall somewhere in between. So before we kind of move any further, you can make a little mental note to yourself which one you fall under in terms of your risk tolerance. But what I wanted to do is share with you, based on all the different trades that we've tried entries based on the 10 delta calls, which are the very conservative calls, which have a relatively low chance of you losing your stock, all the way to the aggressive 30 delta calls we've tested over the last 10 years. What we found is that when you choose the conservative strike prices, you're going to get more upside, which means that your stock is going to have a lot more room to run to the upside before you have to lose your stock. Versus if you're very aggressive, you're going to get more premium up front, but you're going to have much less room for your stock to run higher. So we tested all of these different scenarios across 500 different stocks, and what we've found is that it's actually much better to take smaller premiums, collect small premiums, but give your stock that opportunity to run. Because if the stock really runs up, but you've limited your upside because you've sold a really aggressive call, you're going to lose more money on that short call than you would if you've given yourself that room. So based on our research, it's actually best to be more on the short, more conservative end of the spectrum. So what we found is about the 15 delta calls are approximately the best ones to sell if you're looking for long-term income for your portfolio. And the reason really is because you want to give yourself that upside. You want to give your stock that opportunity to run up. Sometimes it could be because of earnings, it could be because of a product or a news announcement or whatever it is. I think some of the best examples is, when LinkedIn got acquired by Microsoft, a lot of people that had sold very aggressive covered calls were not participating in any of that upside at all. So it's best to have that a potential upside when you can. So again, just to summarize, when it comes to selling covered calls, there's 2 things you need to choose, an expiration date and a strike price. And based on our research, short-term calls with the expirations for about 30 to 45 days out is the best. And with strike prices that are more on the conservative to optimal spectrum, so somewhere right in between, about a 15 delta call gives you the best return long-term if you're looking for consistent income for your portfolio.
Tony, I love that data that you brought. I got to say, this is exactly how I was taught to trade covered calls and generally income strategies by floor traders. And it doesn't shock me that the data backs up exactly what you're talking about, because that's what the pros do. The pros know this. My guess is the pros probably crunched these numbers already, but we have Tony to help us with that here. It really is institutional level research that we're providing here for Chaikin Analytics and OptionsPlay customers. So it's fantastic. What I'd like to do now is take that information and apply it to some ideas that I found. Oh, first, how did I find my ideas? Well, there's certain stocks that lend themselves better to covered calls than others. Stocks that are blue chip, low growth, kind of slow and steady with good dividend yield, they tend to be the best stocks for this kind of strategy. Remember, this is a fairly conservative strategy. You don't want things with like a beta of 4 here. Honestly, you don't want things with a beta of 1.8 or 2. You want to have fairly steady as it goes stocks that pay a little bit of a dividend. Generally speaking, you don't want to do these on Amazon, Apple, Facebook, right? Because those have real growth potential, and the growth that you get, as Tony said, the upside becomes more valuable than the covered call strategy can provide for you. So what I did was I ran a screen using Chaikin Analytics. We have a great screener. So I ran a screen for covered call candidates. I looked at value stocks that are bullish with our classic bullish credentials we talked about a little bit earlier, things with a nice persistency of money flow and relative strength. I look for mid and large caps, and I said, give me a little bit of a yield at least. I want to see at least a minimum of 1%. Some of these have much more than that, but that was a great way to just kind of cut out anything that was not really optimal for a covered call strategy. And I really like the covered call strategy. We have a lot of subscribers that are long-term buy and hold guys. And I'll tell you, I'm fairly young. My dad says I'm very young. Bless him. I tell him he's very young too, though. So anyway, and I use covered calls because I have a section of my portfolio that is dedicated to buy and hold and sell covered calls against it. It's a great, steady as it goes, compounding growth strategy. So I picked out DR Horton off of this list. I took a look at it. You can see that DR Horton had a bullish personality change back in February, March. We got a nice couple of buy signals in there. And we're starting to get to a point where a covered call looks fairly attractive. I haven't talked much about our timing indicators too much, just a little bit. I did mention that we have these buy signals that came up here. So these are all oversold buy signals. But one of the things that we look for at Chaikin Analytics, and these line up quite often, is we want to take an entry in these positions when they're going to have the best chance of a little bit of a pullback. Why? Because we really want to hold on to the shares. So when we are overbought and up at that upper band, that's a great time to do a short duration trade. Covered call, short duration, 30 days, comes down, and you can then buy it back or it'll expire worthless. Same thing. And now we're coming right back to the same scenario again. All right. This I see repeat itself over and over and over again. We get to the upper band, we get overbought. Usually there's a little bit of digestion or a pullback. So look how many times in DR Horton you could have sold an out of the money short duration covered call and generated a little bit of extra yield. So the example that I found was this example. So I went into OptionsPlay and gave me this. Now this is based on my the default settings that I had, which were short and short duration and optimal is the settings that I had on it, and spit this out. It gives me the ability to sell the 38 strike. So that means that I will not get this called away from me unless it gets above 38 at expiration. And on top of that, I'm going to take in 41 bucks for that, which is the equivalent of, and you can see this here, over 1%. That's your return, over 1%, right, like that. And if you could do this all year, you're going to come up with an additional nearly 12%. A lot of people, I think, don't realize the value that the asset value that they're sitting on. I have a lot of subscribers I coach that they're not just into stocks, they have rental properties as well too. And of course they want appreciation in their rental properties, but what they're really looking for in those rental properties is monthly income, consistent monthly income. You have an asset sitting in your IRA, sitting in your cash account, sitting in your investment accounts. it's an asset that you can leverage to generate consistent income. And with Chaikin Analytics, we can give you some high probability setups. And with the OptionsPlay tool, you can quickly and easily identify if they meet what you're looking for. So this is just one idea. And one other thing, this is great, and this is one of the ways that I use this to teach people, but it's also one of the ways in which I analyze my own options trade, is right here. It gives me something that says POW. Now, that's a statistical measure. It stands for probability of expiring worthless. So that means without any indicator, that doesn't take into account that I know that we're almost overbought and toward the upper end of our range. It doesn't even include that in the calculation. It just says simply on a statistical basis, you've got a 3 in 4 chance of this working out for you. And as a Chaikin Analytics subscriber with our tools, your odds are better than that. So you're really going to be able to find opportunities to maintain a position in a stock that is appreciating in value while at the same time pulling money out of that stock consistently for income. So a worst case scenario here, as Tony said, there's really no downside to this. If you're long the shares, you have the initial share risk anyway. This helps cover a little bit of that risk. It reduces your cost basis by 1%. But the worst case scenario here is it gets taken away from you at $38.40, which is over $2 higher from here, which is somewhere like 6-7%. Tack on the yield, you could make 8% in 39 days. 7-8% in 39 days sounds pretty good. And then we have something what we call rinse repeat. We just go and find another example like this. If it gets called away, we just go find another idea. It's a technical term, rinse repeat. All right. So that's kind of what I did. I said, all right, that was a good example. How about another one? Constellation brand beverages. Again, buy signal up here. We had some back here. This has been a very, very strong performing stock. What you're looking at really in the past 5 years, this is the only real pullback the stock has had. Some of you may be familiar with this stock, but it is a great covered call stock as well, right? Has a nice rhythm to it. You have a series of highs and lows that line up very nicely with our proprietary overbought, oversold indicator. It's nicely tacking back and forth between these bands. And we're at a point right here, again, where we are both near overbought, and actually in this one we are overbought, and upper band. What we expect to happen is the stock to just roll over a little bit, and this is going to give us an opportunity as the overbought, oversold rolls over. The stock should, at the very least, base and roll over a little bit. What we do is we sell an out of the money call. That gives us some upside potential. Out of the money call, low deltas. We teach individuals all about this. We have a weekly session at Chaikin Analytics, and we teach people all about this. And if you're not familiar with the term delta, don't worry. You can learn that. We'll teach it to you. All right. So what do we get from Constellation here? Well, in this one, I found the 210 covered call, which is, again, about 5% higher than where we are now. I'm going to get paid $3.50 for it. So my real exit point is not 210. That's the strike. That's the strike that if it gets past, I'll have to unload it at. But remember, I'm taking in also $3.50. So my real exit point is $213.50, which is a good solid 5 or 6 points above here, plus any dividends you may have received. And again, look at if you can do this, this is one shot, you get almost 1 3/4%. And if you could do this yearly, consistently, and if you have the right tools, you could come out with over 17% in a year. That's pretty impressive. Just off of writing cover calls, that doesn't even take into account any potential appreciation in the shares. Cover call strategy is a great strategy. Great strategy. It's conservative, it's slow and steady, but it is very profitable and relatively safe. not a lot of risk in it. You're giving up upside. You're not actually risking anything to the downside. So it's a very good strategy for generating income and helping compound your gains. All right. Every little percent we can get, we want. So covered calls are a great way to keep adding percentages on to your already appreciating stocks, because you should be in bullish stocks with positive power gauge ratings. So you should already know that you have a likelihood of, in the long term, going up. That's Constellation Brands. I've got one more from you. I am aware of our time. I want to wrap this up shortly, but I have a couple of pieces, a couple more things I want to show you that I think you're really going to enjoy. So one more example real quick. This is Eastman Chemicals. This is another one that I found. It had been, you can see on the far left, it had been kind of a downward trend line. Then we had a nice earnings surprise, and you can see relative strength flips. The power gauge happened to go a little bit ahead of that. You can see the power gauge. Again, it's a forward-looking model, so it doesn't shock me. In fact, it makes sense to me that it was picking up on the underlying bullish potential of this stock before we even got to earnings. Once we're there, you see we have a couple of nice little entry points coming up on these buy signals. And once again, a repeatable strategy. I take one glance at this and I say, hey, we're bullish, it's going higher. And then I look up and I go, ha, that would have been the ideal time. Now it's not so bad either. I went and I looked at it. It's pretty good, but you can see overbought, short-term high. Overbought, well, there's one that may not have worked out, but all the rest would have been fairly profitable for you. And you know what? If one doesn't work out, it just means you made money, right? So that's not so bad either. When we say one doesn't work out in this strategy, that just means you made profits. Think about that. So I went in and I looked and I found Eastman Chemicals, 1% return. Again, 12 over the year. If I could do this over and over again, 12%. Pretty good odds of expiring worthless. Makes me know that I'm in a good spot. And here, 87.5 covered call. Tack on my 90 bucks, that gets me to 88.40. We're at $84. That's almost 5-6%. And with the return on the covered call as well, that's not bad for 39 days either. So if that's something that you think would help you, then you should look into learning covered calls if you're not doing them already, and we can help you do that. Now, to do that, you're going to need a directional edge. You're going to need all the other things, because just writing covered calls blindly is not really going to do much for you. And not understanding the right entries, the right strikes, the right expirations, that really can harm you too. A lot of times new options traders don't understand the right entries and the right expirations, and that's something that OptionsPlay has helped solve for new traders right off the bat. Because you can look at it, Tony, I can look at this and I can see, you know what, that middle number there, that 75, that's not a good strategy. That's not what I want.
Yeah, one thing to point out is when you're using the OptionsPlay for directional strategies, one of the things that we have is called an OptionsPlay score. And what that does is it gives you an idea as far as what the risk to reward of an option strategy is, and allows you to compare different strategies side by side on a level playing field, so you can truly see what the risk to reward of each strategy is. And it's color coded for you, so you don't have to memorize what's good, what's bad. You just know that green is good. Green means that you have a good risk to reward. Red means the bad risk to reward. And what this is really designed to do is, because when we were traders back in the day, we had to crunch all these numbers in our head manually to get to figure out roughly what the risk reward of each one of these trades were. And what we wanted to do is not only provide you with a tool that can help you find good trades, but way more importantly is to help beginners avoid bad ones. So when you see a trade and you're looking at an option strategy, maybe you have a great stock that you think is bullish and you want to take some option strategies on it, but you see that the OptionsPlay score is very low and it's red. What that's doing, it's telling you to avoid trading those trades. And that's really important because like you were saying before, what's important for your portfolio is the stocks that you don't have. Same thing with options. It's really important to know which option trades are bad ones and to avoid them. One one bit of information is in the US, we have about 4,000 stocks that you can trade options on, but the vast majority of them is not very liquid. And a lot of times you can't tell that, but when you're looking at an option chain, whether you're going to get a good fill or whether the spreads are too wide. So what we do is we already account for all of those things when we calculate your options play score. So if you pull up a stock, you're bullish on it, and you want to take some option strategies, and you see it has a low options play score, that just means avoid trading options in that particular name. You might be better off just trading the stock.
It's a amazing tool. It's wonderful that we have it integrated. I use it on a daily basis. This has really, when Tony says you used to have to crunch numbers using an options chain, I have flashbacks of my pen and my pad calculating break evens, risk reward, where's this likely to go, what's the volatility, all of that. I don't have to do any of that now. Couple clicks and it's right in front of me in OptionsPlay. And if I want to compare it to something else, as Tony said, on an even playing field, I can do that just as quickly and easily. It's just 3 more clicks, boom, boom, boom. And now I can look at 2 different option strategies with 2 different expirations and 2 different strikes and get a sense of which has the best risk reward, which one has the best odds of success. Are either of these good strategies for me? Maybe neither of them are, right? Maybe they're both terrible. And OptionsPlay is going to help new individuals understand which ones to avoid, and advanced options traders like myself quickly and easily hone in on the best strategy to maximize what we're trying to achieve. It's a fantastic tool, Tony. I really, it's helpful for me, very helpful for me. If it helps me, it's got to be able to help you as a Chaikin Analytics subscriber.
Thank you, Josh.
It's my pleasure, Tony. So a couple more bits of information, and we're going to wrap this up. First, drum roll, we won an award this year. We won an award for the Best Stock Ideas Platform. I don't know where you get your stock ideas out there, but we won an award for having the ability to find the best ideas from Benzinga, which is a well-known financial technology award giver. Right? So Benzinga said, we've got the best ideas. What do they say we had it for? We have it for something called the Discovery Engine. I haven't even shown this to you today. It's fully integrated into the Chaikin Analytics platform. We've got so much that I could show you, so much value in here. We had to I couldn't do it all. But simply, the Discovery Engine is like a Pandora or a Netflix for stocks. So when I go on my Netflix and I click on the show that I like to see, what does it do? It says, hey, you enjoyed Seinfeld? You might enjoy these other comedies, right? If I go into Pandora and I say, hey, listen to the Beatles, you know what it's going to do? It's to say, hey, you like the Beatles? You might like their contemporaries. Check out these songs. Well, Mark has done this with another quantitative model, unemotional, quantitative model, and he has taken that same concept to stocks. You like your Facebook stock, you want to find other stocks like it? Here you go. You have a terrible stock in your portfolio, you have advanced auto parts in your portfolio. Not only has Mark shown you other stocks like it that you could say go short, but if you're a long only trader, he has put in, this is stroke of brilliance, potential swaps. You have advanced auto parts in your portfolio, you don't want it, but you want to still be in some of the bullish stocks in that industry. Here's a list of stocks that are opposite of this, and you can replace your advanced auto parts with one of these should they meet your investing goals and needs. So that is the Discovery Engine. I used it, I plugged DHI, so one of the things I screened after I got that one, I said, oh, let's see what else is like this. I plugged it in there. That's how I came up with Constellation Brands using this discovery tool engine. So that comes along with Chaikin Analytics. We didn't have a lot of time to talk about it, but it's a great way to find stock ideas. Another great way to find stock ideas are Mark puts out a weekly newsletter, and in it he has his picks of the week. One of them was advanced auto parts, and you'll notice in here it says advanced auto parts, AutoZone, and O'Reilly Automotive. Now, how do you think he found those? Look what pops up right here. Auto parts goes in, AutoZone and O'Reilly come up. There it is. And then look what happened. Sell signal came up not too long after, excellent opportunity, huge move lower. Anybody who was a subscriber who took any one of those trades should have paid for at least one, maybe two subscriptions just like that. So we've gone through all this. We've talked to you about how to gain your directional edge, how you can gain your timing edge, how to play good defense, pairing this with options play to help you find nice covered call opportunities. This is from Hal, or sorry, from Ken. Got another one like Ken. His name's Hal, but this is from Ken, and this is from a month ago. It might be the best testimonial that I've ever received. Joe knows Ken well. He's worked with him closely. I've coached him. He started with us in January, and following the process, he can take a look at a stock and he knows in a few seconds whether or not he should be bullish or bearish on it. And then a few more seconds, he knows whether or not it's a good entry or exit point. And he took that tool, he took that edge he has, that I have, that our Chaikin Analytics subscribers have. He paired it with the power of options, went into OptionsPlay, found the best strategies, and I hope he's on his boat somewhere. So 20-factor model, the stock discovery engine, we talked about these things, the screeners, the options. Normally we charge retail price for this is $19.50. Our webinar special is only $17.50. This is going to be good just for this week. In addition to all of that, I know, yeah, there's more. We have intraday charts. I know that's important to people. Again, I couldn't talk about everything tonight, but we have intraday charts. We have earnings alerts. I know a lot of people like to play earnings. We have earnings alerts for you. We have earnings alerts based off of our proprietary algorithms. So our power gauge rating helps generate some powerful earnings alerts for you. Also, and this is important, we've got this great tool. You want to get up and running on how to use it. If you subscribe today, you could be on an onboard session, a small group tutorial by Wednesday, or if you'd like, we could have a recording emailed to you tonight. You could be on the platform and learning how to use it tonight. We do small group tutorials for all kinds of things. We have an onboard session. Joe does some pre-market sessions as well as some option sessions. I do another option session in the middle of the week. There's tons for you. You also get unlimited group coaching and one-on-one coaching. So we can sit down with you and have a conversation and understand exactly what your goals are, and then take the parts out of Chaikin Analytics that are going to help you achieve your goals, because that's what it's about. Finally, we have a morning insights from John Schlitz. John Schlitz is our chief market strategist. This is another great place to get a quick snapshot of what's going on in the market from a very impressive guy. He's our chief market strategist. He's worked with Mark for a long time, and he also puts out some stock ideas in there. Just another great way to find good stock ideas. Malden, John Malden, there's a million subscribers and followers to Malden Economics, very fundamentally based. He has integrated this into his due diligence, right? All fundamentally, he's integrated this into his due diligence. It helps him with vetting and identifying potential investments. Very impressive. We're going to cut you an even better deal, apparently. $16.50. If you subscribe, $16.50. You can subscribe online, chaikinanalytics.com/options, or you can call us. You want to know if you have a one of those classic bears that could be eating your portfolio? Call us. I've got colleagues here that could tell you in a few seconds, I'm sure, just by looking at the power gauge and the relative strength. So everybody, I appreciate your time with us tonight. Tony, thank you so much for being with us tonight. Our friend and partner, Tony Zhang. I really appreciate you hanging out and helping me present. So carry some of the water for me. Thanks, buddy. And everybody else, have a wonderful, wonderful weekend. Tony, anything else?
Nope. Thanks everyone for joining. I hope you guys found that useful. Again, once you have an access to the Chaikin Analytics, use the OptionsPlay tab to help you guys quickly find option strategies regardless of what directional views you have on the underlying stock. Thanks, everyone.
Thank you, Tony. Everybody have a great night, and I look forward to speaking with you in the future.